Good afternoon, ladies and gentlemen, and you are welcome to the first Monetary Policy Committee meeting for 2023. And let me seize this opportunity to, sorry, mic off. Yeah, let me seize this opportunity to say Happy New Year to all of you and wish us a prosperous year. The Monetary Policy Committee held its first meeting for 2023 on the 23rd and 24th of January 2023 as optimism of a rebound in global output recovery waned considerably, giving room for increased concerns of a likely global recession in 2023. This is driven by several global shocks impacting negatively on growth and price development. Major headwinds to global growth include ongoing geopolitical tensions in some regions, intensified disruptions to the energy market, persisting supply bottlenecks, resurgence of the COVID-19 pandemic in major industrial cities in China, and tightening external financial conditions. In addition to these, the slow growth in global trade, continued volatility in the oil market, and growing private and public debt portfolios are clear signals of increasing uncertainty, imposing a drag on growth. Private and public debt portfolios are clear signals of increasing uncertainty, imposing a drag on growth. Private and public debt. In the domestic economy, output growth recovery was subdued in the third quarter of 2022, but expected to recover moderately in the fourth quarter on the back of continued support of both monetary and fiscal policy through various interventions in growth-enhancing sectors. At this meeting, the committee reviewed these and other developments in the global and domestic economic and financial environments in 2022, as well as the outlook and risks for 2023. 12 members of the committee attended this meeting yesterday and today. The global development. The committee noted with concern the growing evidence of increased militarization of the war in Ukraine and the consequence of a prolonged war on the recovery of the global economy. It also noted the renewed concern of the possibility of yet another pandemic reverberating the global economy in 2023 as infection rates rise in China following its lifting of COVID-19 restrictions. Two factors alongside the tightening of global financial conditions associated with the ongoing normalization of monetary policy in the advanced economies remain major headwinds to global economic growth. The combined impact of these shocks on the global economy could result in further disruptions to commodity and energy markets, as well as the efficient functioning of global supply chains. In the advanced economies, fiscal policy retreated to give way to monetary adjustments, while in the emerging markets and developing economies, fiscal capacity is being greatly undermined by the area of shock spillovers from the global economy. The International Monetary Fund, the IMF, in its October 2022 World Economic Outlook, retained its global output growth projection for 2022 at 3.2%, but was further downgraded in 2023 forecast to 2.7% compared with 2.9% in its July 2022 forecast. The World Bank in its latest forecast indicated a much lower growth expectation of 1.7% for 2023. On price development, The MPC observed that inflation in most advanced economies, although trending downwards, remains significantly above their long-run objectives and expected to remain elevated throughout 2023. This is driven by the continued high price of food and energy, a fallout of the war in Ukraine, lagged impact of the massive liquidity support rolled out to douse the impact of the COVID-19 pandemic, and persisting disruptions to the global supply chain as China faces a renewed surge of the pandemic. Fears that Russia may renege its commitment to the Black Sea grain deal is also building expectations of possible rise in medium-term price levels. In the emerging markets and developing economies, inflation is expected to moderate marginally in 2023, but remain broadly elevated due to a combination of factors such as the persisting high price of grains and other commodities, continued exchange rate pressures, and other legacy structural factors. In the global financial markets, the continued normalization of monetary policy has led to the tightening of external financial conditions and increased volatility in equities market. With the increased fears of a likely global recession in 2023, investors have commenced a move towards safe haven assets such as gold and silver to safeguard their portfolios. In the advanced economies, corporate debt levels remain considerably high as pressure builds to avoid default scenarios with the continued hike of monetary policy rates. In the emerging markets and developing economies, the persistence of rising public debt profiles and capital flow reversals are putting severe pressure on exchange rates, posing a challenge to external sustainability. Our domestic development. Available data from the National Bureau of Statistics reveal that real gross domestic product grew by 2.25% year-on-year during the third quarter of 2022, compared with 3.54% in the second quarter and 4.03% in the corresponding period of 2021. The economy has continued on a path of positive growth for 8 consecutive quarters. This is driven largely by the support by the bank and the fiscal authority to growth-enhancing sectors. Staff projections showed that output growth recovery is expected to continue reasonably in 2023, given the expected sustained positive performance during the fourth quarter of 2022 and steady rebound in economic activities. MPC welcomed the moderation in inflation following 10 consecutive months of uptick as headline inflation year-on-year declined marginally to 21.34% in December 2022 from 21.47% in November 2022. Month-on-month headline inflation, however, increased to 1.71% in December 2022 from 1.39% in the preceding month due to a rise in consumer spending during the festive period. The committee observed the continued growth in money supply with broad money M3 growth exceeding the 2022 provisional benchmark of 15.21% at 16.52% year to date in December 2022, compared with 13.92% in November of 2022. This was largely driven by increased claims on other sectors like other financial corporations, state and local governments, public non-financial corporations, and the private sector. Money market rates oscillated below and within the asymmetric corridor of the standing facilities corridor, reflecting changing liquidity conditions in the banking system. Accordingly, the monthly weighted average open buyback OBB rate decreased to 11.61% in December 2022 from 12.56% in November, while the monthly average interbank rate increased to 12.08% in December 2022 from 11.89% in November. The MPC noted the continued resilience of the banking system, evidenced by the progressive improvement in non-performing loans (NPLs) ratio from 4.9% in November 2022 to 4.2% in December of 2022. Committee also noted that the liquidity ratio was well above its prudential limit at 44.1%, while the capital adequacy ratio remained at 13.8% in December 2022 compared with the preceding month, staying within its prudential range of 10 to 15%. The equities market was bullish in the review period as the all-share index and market capitalization increased to 51,251 and 27.92 trillion naira on December 30th of 2022 from 43,839.08 and 23.88 trillion naira respectively on October 31, 2022. This reflected better than expected corporate earnings and improved investor confidence in the market. Committee noted the marginal decline in the external reserves as gross external reserves decreased by 0.95% at the end of December 2022 to $36.55 billion from $36.9 billion at the end of November 2022. This reflects the exchange rate pressure accentuated by a combination of heightened demand and slow accretion to reserves. The committee reviewed the performance of the bank's various interventions aimed at stimulating production and productivity across the real sector. Between September and October 2022, under the Anchor Borrowers Program, the bank disbursed 41 billion naira to several agricultural projects, bringing cumulative disbursement under that program to 1.067 trillion naira, to over 4.6 million smallholder farmers cultivating or rearing 21 commodities across the country. The bank also released 300 million naira to finance large-scale agricultural projects under the Commercial Agricultural Credit Scheme (CACS), bringing total disbursements under the scheme to 745 billion naira for 680 projects in agro-production and agro-processing. In addition, the bank released a sum of 48.3 billion naira under its 1 trillion naira real sector facility to 7 new real sector projects in agriculture, manufacturing, and services. Cumulative disbursements under the real sector facility currently stands at 2.15 trillion naira, disbursed to 437 projects across the country, comprising 240 manufacturing, 91 in agriculture, 93 in services, and 13 mining sector projects. Furthermore, under the 100 for 100 policy on production and productivity, the bank has disbursed the sum of 20.78 billion naira to 9 projects in the healthcare, manufacturing, and services sectors. This brings the cumulative disbursements under the facility to 114.17 billion naira to 71 projects across manufacturing, agriculture, healthcare, and services. The bank released 4 billion naira under the intervention facility for the National Gas Expansion Program to promote the adoption of compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuel. In the SME sector, the bank supported entrepreneurship development with the disbursement of the sum of 1.3 billion naira and 10 million naira under the Agribusiness Small and Medium Enterprise Scheme and Micro, Small and Medium Enterprise Development Fund, respectively, to support entrepreneurship development in the country, bringing total disbursements under the interventions to 150 billion naira and 96 billion naira, respectively, under the Export Facilitation Initiative. The bank export-oriented projects with a sum of 5.34 billion naira, bringing the cumulative disbursement under the intervention to 44.58 billion naira. The outlook. The broad outlook for the recovery of both the global and domestic economies remain uncertain, with the path to full recovery clouded by significant downside risks. The key risks remain the lingering headwinds from the Russia-Ukraine war, heightened inflationary pressures across several economies, and sharp slowdown of economic activities in China with the resurgence of COVID-19 pandemic across its major cities. Others include the tightening of external financial conditions as monetary policy normalization continues, increasing risk of a global debt crisis as both corporate and public debt levels burgeon, and rising risk of a global recession in 2023. Available data and forecasts for key macroeconomic indicators for Nigeria suggest that the economy will continue to grow through 2023, but at a subdued pace. The continued high level of insecurity, perennial scarcity of petroleum motor spirit PMS, and high cost of other energy sources, increased spending towards the 2023 general election, rising cost of debt servicing, and deteriorating fiscal balances remain the key sources of shocks to the Nigerian economy. Accordingly, the economy is forecast to grow in 2023 by 2.88% by the CBN estimate, 4.2% federal government estimate, and 3% by the IMF estimate. The committee's consideration. At this meeting, although the MPC was delighted that inflation year on year had started to moderate, it was not convinced that a marginal 13 basis points dip in inflation was enough to begin to celebrate. The committee was therefore not of the opinion that a hold or losing option was desirable. This is because loosening under a double-digit inflationary condition will be tantamount to an immediate reversal of the expected further downward trend in inflation. The committee also felt that loosening will negate the objective of dampening the pent-up aggregate demand that fueled the rise in inflation post-COVID-19 pandemic. As for hold, the committee was reluctant in considering this option because a hold option will signal MPC's quick adjustment of its policy stance due to a one-time marginal decline in inflation, suggesting a weak thrust in its previous policy stance at stemming inflation. The MPC was therefore unanimous in its position to continue to tighten. However, the dilemma at this meeting was whether to continue tightening aggressively or moderately. To the committee, a moderate tightening may slow the rate of deceleration in inflation without necessarily hurting output. For those members who felt that an aggressive stance was needed, they were of the view that Nigeria's inflation at a rate above 20% was already a threat to growth and among the highest in the world. To this group of members, aggressively raising the policy rate was paramount to reining in inflation because an aggressive tightening stance will further narrow the negative real interest rate margin. MPC also feels that a tightening stance would signal confidence in the effectiveness of its monetary policy direction to rein in inflation, improve financial system stability, and moderate exchange rate. The committee's decision. Members welcomed the recent deceleration in year-on-year headline inflation, noting that the persistence in policy rate hikes over the last few meetings of the committee has started to yield the expected decline in inflation. The committee thus deliberated on either to hike rates further or hold for the impact of the last 4 rate hikes to continue to feed through. At this MPC, therefore, the options considered were primarily to hold the policy rate or tighten further to consolidate the gains of previous rate hikes. Loosening, in the view of members, would gravely undermine the gains of the last 4 rate hikes. MPC noted the continued upward risks to price development characterized by the forthcoming 2023 general elections, perennial scarcity of PMS, continuing rise in other energy prices, exchange rate pressures, as well as rising insecurity. Members, however, noted that the current Naira redesign and cash withdrawal limits policies are huge moderating factors to price development, as currency outside banks is expected to continue to moderate beyond the implementation stage of these policies. MPC was of the view that although inflation rate moderated marginally in December, the economy remained confronted with the risk of high inflation with adverse consequences on the general standard of living. The committee therefore decided to sustain the current stance of policy at this point in time to further rein in inflation aggressively. One member voted to increase the MPR by 150 basis points, 4 members by 50 basis points, and 7 members by 100 basis points. In summary, MPC voted to 1. Raise MPR to 17.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the corridor, and 3. Retain the CRR at 2.5%, and 4. Retain the liquidity ratio at 30%. I thank you for your attention.